Good morning, everyone. Thank you for joining in on a Saturday morning. I know it can't be easy. For this webinar, we're going to be talking about NIO. NIO is one of our PMS funds, and it's a multi-asset fund which is specifically built for the NRI investor. So without any further delays, I will get started. Right. So what do NRIs really want? Right. So firstly, they want the investments to be based on a particular goal. So they want to have their goals mapped to their investments. Number two, they want the operational aspect to be easy and efficient. So whether it be, shifting money from one asset class to another asset class, or bringing money in from wherever they are outside of India into India, they want that aspect to be easy and efficient, right? Number three, they want a transparent view of all of their asset classes. So what they hold and what the value is, and in terms of like charges, fees, all of that, they want asset transparency and operational transparency and efficiency, right? Um, and also, they want the transactional efficiency to be able to invest in India. So, broadly, these are the four things that NRIs really want. Right. So, let's look at a few investment favorites, which have been, investment favorites for the NRI for the last, decade or so, right? So when it comes to NRE FDs and FCNR deposits, the investment horizon is set by the banks or the institutions where you're buying them from, right? So it's kind of inflexible if you're a person who's investing with a goal and the goal doesn't, go really in line with the sort of investment horizon offer. Right. But that being said, it is a great option for the NRI investor because your returns are tax free with the NREFT. And coming to insurance plans, right? So in this year's budget, in last year's budget, yeah, it's now in last year's budget, the tax benefits for endowment policies and money back policies have been reversed, right? For premiums which exceed 5 lakhs. And similarly for ULIPs, the maturity proceeds can also be taxed, right? And in the long term, neither of these options would provide you with sufficient enough returns, and nor do they provide, enough cover in while looking at it from an insurance point of view. And the returns from these products would be similar to a bank FD, or in some cases, they may be below them as well. And with ULIPs, the added costs of the fund would eat into the underlying returns, right? Where even if your returns are good enough, your added cost plus having the insurance component may sort of reduce the efficiency of that product, right? So instead of a ULIP, one might look into buying a term plan for insurance cover and a good mutual fund separately for market exposure, right? So this latter option would be cheaper and would give you better results in the long run. Now, moving on to real estate, right? Finding and monitoring the property is the first major hurdle. And there's also the question of tenant behavior with regards to maintaining the property and paying rent on time, right? And eventually, you might need to do some repairs when the house is kept idle for too long, and an asset which is supposed to, create income for you might as well end up costing you more than that just to maintain it. So finally, you have structured products. So these are debentures and they're linked to an index. And in most cases, this index is the Nifty. So if this sort of structure sounds familiar to you, MLDs are a type of structured product, right? They come with predefined conditions on, returns on the upside and the downside, right? And these are linked to the performance of the underlying index. And another thing to keep in mind is your personal risk profile. So most investors, as we found, do not have the adequate risk profile to comfortably invest in these products. So they are in essence a derivative product, and sometimes they can be extremely complex with various, stipulations for payouts. Right? Generally, they are fee heavy, and in most cases, the payoff may not be worth the risk. And by actually investing directly in the underlying index, you could make higher returns over the period and have better liquidity. So a key thing to remember is that for a structured product, your upside is also capped. So if you're expecting the index to heavily outperform, then investing in the product may actually sort of put a ceiling on how much money you can make. Right. So what is the India opportunity and how has it changed over the last 5 years? Firstly, we've had two major reforms, the GST and the Insolvency and Bankruptcy Code. And these two have transformed India into a more compliant economy, right? So your tax revenues have been buoyant, and the IBC has brought in solutions to long-standing issues. And the process of actually, declaring insolvency and bringing in a resolution has come a long way from the first time of when it was implemented, right? And it's now more structured and your guidelines more clear. And this process has greatly helped clean up the financial system. So banks are well capitalized, NPAs are at multi-year lows, and you have a more lean banking system, right? And you know, banks have been more forthcoming into adopting newer technologies, and your banking credit right now is also growing. So the production linked incentive scheme, the PLI scheme, right? This has opened up more opportunities for the manufacturing sector and has created a lot of jobs. So a few stats from the PLI scheme: electronic manufacturing has been, the most successful in attracting investments. So we've attracted investments of around 5,000 crores, and this has contributed to a production value of around 2 lakh crores. And of these 2 lakh crores, 80,000 crores were exported, right? Now, talking about the export sector, right? The export sector is expected to see, really, sort of incredible growth in the coming years. And we've already seen companies like Apple manufacturing and exporting from India, right, for the last couple of years. And pre-COVID, India's manufacturing export sector has traditionally seen a growth between 5 and 10%, right? And according to Bain, the last 2 years have seen an annual growth rate of over 15%, right? So contributing to making India a global heavyweight, supply chain diversification, the PLI scheme, greater sort of capex investments into manufacturing, more M&A activity, VC investments in manufacturing, right? A multitude of things. So what do we need to succeed, right? So we need a clear export strategy, the right partnerships, and efficient execution, and good capex efficiency, right? If we can get all of these right, then we can really make an imprint on the global manufacturing industry. Right. So why NIO? So as I said, NIO is a multi-asset fund. So the whole concept of multi-asset investing, right? It helps you get a plethora of asset classes with one product, right? And with NIO, you have a fund that diversifies your India exposure. So with one fund, you have everything that you essentially need, like the bare minimum for your India investment, right? And furthermore, NIO makes measuring performance extremely easy. And as everything is within like everything is within the same portfolio, everything is within the same report, you can, sort of measure performance much more easily. And one of our main USPs is that you get true dynamic asset allocation, as we have. So we have no upper limit or a lower limit on your asset classes. And so because we have no upper and lower limit on any of our asset classes, you also get ample opportunities to scale. And I'll talk about scaling a little bit further into the presentation. So this chart shows the best performers for each year, right? And as you can see, assets work in cycles. So what's worked yesterday may not necessarily work tomorrow. And looking at this chart, right, if I can bring your attention to, some of the aspects, if you see the commodities index, right? It was the biggest loser for 2 consecutive years in 2014 and 2015, but it won big in 2016, right? Emerging market equity also went through a similar period between 2008 and 2009, right? You see the worst performer for 2008 has been the best performer for 2009, right? And so did gold, right? From 2010, right? If you look at gold in 2010, of course, 2010 and 2011, it was in the top two, and then you sort of saw a stagnation for the entire asset class between 2012 and 2015. Right. And again, from 2020 to 2022, was the top performer in 2020. It's at the bottom in 2021, and it's been in the top three for 2022 and 2023. Right. So this sort of cyclical performance holds true for countries as well. And if you take the US out of the equation here, you can see rotation in returns between Asia, India, Europe, and China. And, with the current economic and geopolitical climate, we can expect this table to look very different in the next 10 years. So a key thing to remember is throughout, the decade on the chart, right, 2011 to around 2021, you had near zero borrowing costs in the US and more predominantly in the Western world, right? And now going forward, the sort of zero interest rate, zero borrowing cost scenario is highly unlikely, right? You're overburdened with sort of debt in the US, and money won't be that easy, right? At least for the foreseeable future. And this, this combined with the India opportunity, as we've seen, this looks drastically different now from 10 years ago as well. So NIO and more broadly, ithought as a house, right? We follow the contrarian way of investing. So broadly put, this means we create positions in assets which are out of favor. We slowly build these positions to a certain level. We stay invested, and when the asset class comes into favor and starts getting crowded, we unwind our position and exit the asset. So here's an example of what we did in the pharmaceutical sector. So this was not in the PMS space, this was in the mutual fund space, right? But the whole philosophy is the same, right? So your building of positions and exiting are broadly, a very similar sort of process, right? So we started building the pharma sector position in 2017, and we continued it through 2018 and 2019. And this was a period when the sector was plagued by various troubles and including, US FDA interventions. And this negative sentiment capped our downside risks, right? So we were able to build a sizable position of around 25%, right? Around, March 2020, we had around 22, 23, 25%, right, for the sector as a whole. Our initial hypothesis was that it would take a while longer to play out than it actually did, but COVID hit and the pharma sector took off. So we had the opportunity to take the money off the table, and this, we took this opportunity to exit, and we were fully out of the sector by mid 2021, right? So from that point forward, the market had moved. The other aspects of the market had moved, and the pharma sector hit a bit of a stagnation, right? And so over our investment period, the pharma sector gave us an annualized return of about 14%, right? And this was a 2% outperformance over the Nifty. So let's see how every investor can win, right? Sort of key checkpoints. So firstly, when you bet on India, bet big, right? For the next 10 years, so India is the only country slated to achieve even close to 7% growth. And secondly, be in the right asset at the right time. So for this, NIO is able to take advantage of all assets at all points in time, and we're able to address this aspect better, right? And we have a mandate that allows us to be dynamic in our allocation. So we also have the ability to take money in consistently, and we have an option in NIO where we do take SIPs, right? Similar to what a mutual fund does. And you do have really good ability to scale in this product, right? And so again, this brings me back to the talk of scaling. So we buy what's attractive at a given point in time, right? And we have no model portfolio. So if you come in today, your portfolio would look much different from someone who came in 6 months ago, right? And if you come in today and you add capital, say 6 months later, add additional capital, um, the the money that you add 6 months later would be used to buy what's attractive at that point in time, what's attractive 6 months later, right? So um, so because we buy, what's attractive at a given point in time, we have no model portfolio as such, right? But you can rest assured knowing that you get the best possible asset class when you add to NIO. And this again makes every portfolio in NIO different. So you can also align your portfolio to a particular goal when you invest in NIO. So you can say the whole investment is for a goal coming up in the next whatever 4, 5, 6 years, and we can sort of structure our investments based on that. And so what the guidance is for someone who's coming in with a goal is to come in with at least a 5-year sort of time horizon when you come in into any equity related sort of portfolio like. So here's our performance for the last month. So we're holding 82% right now in equity and equity related assets. So this includes, shares and ETFs, right? 12% in gold and silver, 2% in assets outside India, and 3% in liquid assets. So that's 1% in cash, and the 2% that you see in debt is a liquid fund. So it's sort of a cash proxy for us. right? And so NIO follows the multi-asset index as a benchmark, and yeah, your cash levels are 2% as of January. Yeah. So with that, that's the end of my presentation. So we can you can put the if you have any questions, please reach out in the chat box, and I'll do my best to answer. How does NIO make measuring performance easy? Okay, so if you're asking in terms of reporting and such, we send out reports every month, right? And the report would look like this, right? With 1 month, 3 months, 6 months, 1 year, and since inception performance. But so the reason why I say that is because we have everything you sort of need to invest in India, right? You have equity, you have precious metals, you have fixed income as well. So so sort of that aspect has, since it has all aspects, all asset classes, that and it also comes with sort of one report, right? You also get a holding statement that makes performance easy. Minimum capital required to join NIO is minimum capital required to join NIO is 50 lakhs. So that's a SEBI mandate, and that holds true for all PMS funds. Okay, what's specific to the NRI here? So specifically to the NRI is sort of okay. It's okay if you're talking about the onboarding process and sort of that aspect. I would suggest you get in touch with us, and we can have someone from the PMS sales or operations team to talk to you. I I'm part of the fund management team, so operationally I can put you through to better people. Fees 1.5% on the portfolio value. That's the annual. That's an annual. Sort of calculation, but it's payable quarter. So 1.5% of the portfolio value per annum every quarter. There are no performance fees associated with the product. It's a flat fee. It's a flat fee. Yes, sir, I understand. So we can put you through with someone in operations, and they'll be able to clarify this aspect far better than I can. So far the AUM for NIO is around 40 crores. Advisory as an investment advisory. So we used to run an investment advisory practice. We don't so much now. Is NIO Sharia compliant? No, it's not Sharia compliant. So NIO is PMS. NIO is the name of the PMS. So at ithought, we run 4 PMS strategies. So we have Solitaire, we have Sphere, we have Vriddhi, we run 5 PMS strategies, right? We have Solitaire, Sphere, Vriddhi, True Blue, and NIO. So NIO is one of our PMS strategies. Is it a pure PMS? It's a pure PMS, sir. from that aspect, yes, you are correct. The initial investment should be a minimum of 50 lakhs, and then over and above that, you can do an SIP, or you can do a lump sum whenever you'd like. Tax details on the investment, as in, sir? I don't understand the question. Market caps we focus on across the board. Tax details for return purposes, yes, we do. Market caps, we don't have any sort of restriction at that point. So we can, we can basically go wherever we find opportunity. So it can be large caps, small and mid caps, not much right now. I can tell you that. We don't find that many opportunities right now for the long term in small and mid caps. But once they become attractive, yeah, of course, we can go. So we started so ithought as a house, we started offering PMS services in 2019 is when we started. We started with Solitaire, and then over the last 4 years, we've sort of branched out to more strategies. But ithought as a house started the sort of investment practice back in 2009 to no, 2010. Team size. So we have an investment strategy team of around sort of um, 7 people, led by Mr. Sham, and we also have a research team of around again sort of 7, 8 people, and that's led by Mr. Shah. So both the research and the strategy aspects of the house is led by Shams. When did we start the PMS? Okay, I answered that. When did NIO start? NIO started on October 2022. Um, Hurdle rate, there is no hurdle rate since there's no the since there's no variable fee or like a performance fee. There's no hurdle rate. There's only a fixed fee of 1.5% per annum. Are our fees lesser than other PMSs? Okay. So it depends on which sort of PMS you're comparing us to. Right off the bat, I can tell you there aren't a lot of multi-asset PMSs, right? And not a lot of PMSs would sort of give you the value add of telling you actually when to invest more and give you that additional call for capital, right? So what I can tell you is our fees is very, very competitive. We can always, look it up and get back to you on, sort of how we are um, pitched against the market in a broader overall sense. But sort of the value add that you get, I can tell you would, you would really find value in this product. That being said, again, there aren't a lot of products in the Indian market that offers a multi-asset experience, and I don't think there are any products which are sort of dynamic in allocation, right? Usually, when you see a multi-asset fund, be it a PMS or a mutual fund, you'll have a very clear definition right? This fund can invest in equity up to 70% of the portfolio, and the minimum is 30. So the equity range will be 30 to 70%, right? And the rest must be invested in debt or invested in gold or silver or what, right? So since we don't have that, we can be much more dynamic, much more intentional in our allocation, and much more intentional on allocating to spaces with where we find the most opportunity. Target return. So our target return would be sort of inflation plus, say, 6-7%. And the time horizon that we, the time horizon that we'd encourage you to come into would be at least 5 years. Yes, as of now, our equity allocation is at 82%. Yes, and you, so you can, so if you notice, the narrative is that equity is overvalued, right? But we found no, no, no. So what I meant was, for most multi-asset funds, you would have an equity allocation range of 30 to 70%, and we don't have that. So what I meant to say is that we have sort of the flexibility to go wherever we want. That is what I meant to say was we don't have any sort of restriction on, on any range or any sort of allocation or anything. Target return would be inflation plus 7-ish%. So if your inflation is 5%, then your target return would be around 12-13%. Current sectors we invest sort of all across the board, where we find the opportunities attractive. So we have okay, so equity is overvalued. That's sort of the general narrative. But if you look into it further, right, there are a lot of pockets where there is still a lot of opportunity, right? So right now, we're investing mainly in banking. We're investing in financial services. So that includes, insurance and other aspects like, AMCs, sort of credit rating agencies, all of those. We also invest in auto and auto ancillaries, is something that we're really positive in. And we already played the PSU theme, right? We invested in PSU banks, and we also invested in the public sector enterprise. So that's mainly power, right? But we already invested in those, and we've sort of made our money there. And other sort of sectors where we do have money, but we're not, adding any money right now, since it's not in our valuation range. Is So one of those is the consumer products. So we have the opportunity to go back into that when it becomes attractive in our lives again. Okay, NIO, I'll explain how NIO stands out in terms of other products, right? So we have a large cap fund which is True Blue, right? We have a multi cap fund which is Solitaire. So that's your flexi cap, multi cap sort of product. We have your small and micro cap, which is Vriddhi, right? And then you have the multi-asset fund. So that's how NEO stands out. We have the opportunity to go to sort of various asset classes, right, with the same product. And the others are sort of long only equity products, whereas we're a long only multi-asset. So the approximately 12% is a sort of example that I gave, right? It can be inflation plus 7% is what we target at a minimum. If you look at our performance for the last 1 year and since October 2022, we've done 30% and 26%, right? Um, so again, that's sort of a minimum thing that we target. But in the long term, I'm guessing with our strategy, we will definitely beat the Nifty. We have beaten the Nifty since we started in for like the last year and a half. Which type of DMAT? So again, that is sort of from the operational aspect. I can arrange for you to have a call with us, sir. In sort of the operational aspects. I can arrange for you to have a call with one of our sales representatives or with the operations team, and they would be able to guide you much better in that aspect. I mean, yes, 1 year is not enough time to judge performance. That is correct. But NEO does follow the overall philosophy of what we've done over the last 10 years, right? In sort of the advisory space. So for the investment advisory practice, the average returns have been around 17% for those 10 years. So that's again, if you take Nifty at 12%, that's sort of a 5% outperformance over 10 years. So again, that is there, but still, like with the strategy that we follow, we tend to go into spaces which are not crowded, right? And when we build our position over a long period of time, right? And when that space finally starts attracting the crowd, we are already out before before a large part of the crowd actually gets in, right? So again, with this sort of practice, granted, you might see pain points sometimes for a bit more time than you expect, right? Some pain points can be, will last a bit longer. But at the end of the day, when you have a sort of strategy where you go into spaces which are undervalued and not crowded, and when the crowd finally comes in, the turnaround will be really quick, and the turnaround will be really rewarding as well. So that sort of investment strategy tends to work out. Any more questions? We still have about 15 minutes. Okay, so if there are no more questions, we can close the webinar. I've sort of presented our contract details on the screen. So please feel free to get in touch with us, and we can take sort of any further questions or any doubts that you may have had in the webinar, and sort of aspects where you'd like to have more clarity on. Please feel free to get in touch with us. You can shoot us an email or give us a call, and yeah, we can have a discussion offline. Yeah. So thank you for joining in, and we'll see you really soon.